It makes it very difficult for competition to come in when you're an established company with a production cost moat, because you can't compete if they've got the economies of scale, where the more you produce, the cheaper it is, and they're already producing, 70% of the marketplace or whatever. You're coming in new, you don't have the economies of scale, so they're always going to be super much cheaper than you, until such a point as you can scale up. And how do you scale up if you're not as cheap as they are? So it's like a self-fulfilling prophecy that competition is very difficult if you're up against one of those guys. As you'll see, there's no other Walmarts, other companies trying to do the same thing. It's very difficult. So that's an interesting one. The next one is a new one in terms of moats. We've been talking as investors, as a group, all the guys before us have talked about moats for decades. But just recently, there's a new moat that has appeared out of nowhere, and it's called the network effect moat. And how that works is it means that the value of that company, that moat, is that everyone is there. So, for example, it's very difficult for someone to compete with Facebook because everyone's already on Facebook. When you start a new network, no one's there. So why would people start there when nobody they know is on there? And they've got no reach, no audience, no marketing ability. It's very difficult to start one. Yes, people have started ones. Some of them were successful, and then Facebook bought them. Instagram, WhatsApp, etc. is a tale of companies getting bought out because the big guy is big enough to just grab them. But the truth is, it's very hard to start something when everyone is already there. A great example, I would say, is Visa and MasterCard hold almost an entire monopoly on credit card processing machines globally. Those machines are in every shop. Why would a store owner put another machine in and pay those costs when everyone already has a Visa or MasterCard and every shop already has the system? It's very hard to break through a network effect moat. And yes, Visa and MasterCard and these machines have been around for a long time, but we didn't really identify it as a moat until social media came along and showed this is a very valid moat, that everyone is there.
One more, another reason of why this is so hard to start such kind of business is that in the beginning you need to spend basically 2 times more on marketing and acquiring customers, because in the traditional business you need only one type of customers, for example, those people who can buy your product or service. But in this case, you both need to acquire people who will be on your platform as the consumers and people who will be as the sellers. And in this case, you need to spend on marketing twice more money. And it will take so much time and effort to do that, because it's like the special circle when you cannot get the money from advertisers because there is no audience. And there is no audience because you do not have money from the advertisers. And when you can achieve such incredible results with the leveraging and with the scaling, you become extremely powerful and ahead of all competitors.
That reminds me of one that I wasn't going to mention, but now I will. There's another new moat that at least I wasn't aware of until recently. And it's quite interesting and powerful, and it deserves some thought and some study. It is called a flywheel moat. And where this comes from, the concept of it, how it works, is if you are a company like Netflix, you have the most subscribers than any other streaming platform. And you got there, of course, because you had the first mover advantage. A lot of big companies today, they got there by being the first mover advantage guy. Doesn't automatically mean it, but if you are in venture capital or you want to invest in startups, not something I do or recommend. First mover advantage is often going to end up being beneficial. So Netflix got the first mover advantage. Then they got to be huge, and huge amounts of cash flow generation, just massive free cash flow. how they use that free cash flow gives them a competitive advantage called the flywheel moat. And how that works is they spend that free cash flow on growing further with their subscriber base and also creating content. Now, when new guys come in, they don't have as much new content as Netflix does. They can't compete with the sheer amount of content that Netflix is producing. Because they have more free cash flow, they can produce more content. And because they have more content, they can get more subscribers. And because they have more subscribers, they have more free cash flow. It becomes like this flywheel that goes round and around faster and faster. And it's incredibly hard for anyone to catch up because it is like a snowball effect. It just gets bigger and bigger and faster and faster. Who can create as much content as they can? Who can grab as many subscribers as they can because of that content? It's an incredible cycle. Not a lot of companies have it, but if you can identify the flywheel mode and it works in this fashion and it works really well, if you can see it working to a way that nobody can possibly catch up or compete, you might be onto something really strong, and that's a great mode. What do you make of that?
That's a great idea. I haven't thought about that before, but I think that there are a lot of modes which we cannot see when we analyze the company. But there is a great quote of Manish Pabrai, which I remember, is that we need to find companies with the hidden modes. So there are companies with the modes which already know about, like Facebook, Google, Coca-Cola, etc. But we need to look for hidden modes. Not many people understand those modes, and usually such kind of companies are deeply undervalued. But they're extremely powerful because if we can recognize them in the beginning and we can invest our money in them, this can be a long run and we can earn a lot of money on them. Even though the company isn't so great, the management isn't so great, there are a lot of competitors, etc. It doesn't matter.
So this is a huge point. The two main ways of being a value investor in this particular context of what Eugene was just saying, the one way is to be an events-based value investor like myself, where you look for wonderful companies that might be obvious, like Netflix or Facebook, and you do all your different research and you determine if you think it is wonderful, and then you wait for an event, and then you buy it when the market is being ridiculously low versus the value. The other way is to find companies that people aren't even aware of and that they've mispriced because nobody's really aware of it. Smaller companies, ones that don't have analysts following it. Companies like Facebook have 50 different analysts or more, trying to figure out the value all the time. The chances of it being mispriced aren't as it's pretty high to be like a chance to be mispriced, but it's less likely than a small company that has zero analysts looking at it. So some people like to dig deep into companies that no one's following and look for companies that are unappreciated, haven't been discovered yet, are mispriced in various ways, and have those hidden advantages, hidden modes. So that's the two broad strokes ways of going about it. There's actually hundreds of ways of investing, but that's two very obvious ones that are pertinent to what we're talking about.
Yeah, I definitely agree. And if we can find such kind of companies and we dig deep and we use all these principles, we can be really successful because in most cases, as such analysts, hedge fund managers, then they try to earn quick money. They already raised the capital and they promise to investors that they will deliver the returns. And usually most hedge funds, they have the structure in which they will receive 1 or 2% of assets of the investors every year. So in this case, they need to produce some returns. And this cause actions which way they need to make in order to be competitive and in order to deliver 10-15% return. So they usually need to buy and sell their shares without spending so much time on analyzing the companies, analyzing fundamentals, etc. That's why we can just overplay them. by making and spending more time on the one particular company, learning about the management, going to LinkedIn, go to meeting with the management, go to latest earnings calls, learning about the whole industry and the whole history of the company. It will take so much time, and it will take more time, but we will get enormous advantage in comparison to these guys.
We will definitely devote a large amount of time in a future episode to reasons, the many reasons that large fund managers, most of them, do not perform very well. And we will discuss why they do not perform very well. And we will also discuss how you will beat them. But for now, just know that that is coming. And then last thoughts on moats. There is probably hundreds of different possible moats. We've covered the most well-known ones and a few lesser-known ones, but I want to give you guys some thoughts on moats that might exist. They might be valid moats, they might not. These are just some thoughts I've had, and you can think about them too and determine, is this something that indicates a wonderful company that is hard or impossible for others to beat? These are not as solid moats as the other ones, but there are things to consider that are moaty, so moat adjacent. So, for example, looking at the company's market share, are they in the top 5 market share for their industry? And do they have maybe more than 5% of the market share? So if you're number 4 in an industry, but you've only got 1% of the market, I don't really think you've got much of a moat there. But if you're number 3, and you've got 20% of the market or 10%, maybe even 5%, maybe you've got something. If you're far ahead of everybody else and you're in the top 3, you're probably a bit moaty is what I'm thinking. So that's one idea. Any thoughts on that idea before I move to the next one?
I think you said it perfectly, that we can also look at companies who are in the top 3 or top 5, because they probably have better metrics, they have better management. But it actually depends on the industry, depends on the particular company. We cannot be 100% sure that these companies can win in the next 3 to 5 years, because if you look to top 500 companies for the last 10-20 years, they are completely different. And the companies which were on the top list 20 years ago are currently not in actually 200 list, and some of them are actually bankrupt. So we cannot predict the market, but we will definitely can be better in understanding the business, better in understanding the accounts, the finance, and investing in general. This is the end of this episode, guys. We will continue next time. And if you have any questions, please write them down in the comments below. And see you next episode.